Imagine a machine that is so vast, it processes $9.6 trillion, like every single day.
It is a number that is almost impossible to wrap your head around, honestly.
Right. I mean, that is roughly 60 times the entire daily GDP of the United States.
Hmm.
And it is all just changing hands in this decentralized, invisible web.
Yeah, there is no central building. There is no single global exchange you can just point to on a map.
Exactly. But every time you buy a piece of imported electronics or, your company pays an overseas vendor, you're actually feeding this machine.
You are an active participant, whether you realize it or not.
Which is why today we are doing a deep dive into the foreign exchange market, or FX. We have a really fascinating stack of material to go through.
We do. We are pulling from foundational university textbook chapters on market mechanics, the official FX global code, and a comprehensive Wikipedia history.
And we also have an OFX guide on market drivers, plus PNC Banking's actual playbook on risk management strategies.
It is a great mix of theory and real-world application.
Yeah, so our mission today is basically to demystify the gears of this invisible machine. We want to figure out why exchange rates are just in this constant state of flux.
Right, and how the world's biggest financial players actually survive that chaos.
Plus, we will get into the unwritten, and written rules that keep the whole system from just collapsing. And honestly, to even understand what is happening, we should probably start with a really simple analogy from the textbook.
Oh, the milk analogy. I love that one.
It is so good. Okay, so think about the price of milk. If a gallon of milk is $2.50 in the US, the exchange rate is just 2.5 USD per milk.
Right. The milk is the thing you are buying.
Exactly. So an FX rate like 1.09 USD to the euro works the exact same way. You were just buying a currency instead of a dairy product.
Uh-huh.
The currency on the bottom of that fraction is just the good you are purchasing.
That makes it so much easier to visualize. But unlike milk, currency prices float freely, 24/7.
Yeah, the grocery store isn't changing the price of milk every millisecond based on global algorithms.
Thank goodness. But, it wasn't always this chaotic digital frenzy. If you look at the Wikipedia history, it traces things way back to the 15th century.
Oh, right, the Medici family.
Yeah, they were setting up these things called nostro accounts. Nostro actually translates to ours.
Okay, so what did those do?
They basically just tracked foreign and local currencies for textile merchants. It was very manual, very physical. But the hypervolatile market we know today, that is actually a surprisingly recent invention.
Right, it really traces back to the 1970s.
Exactly. The collapse of the Bretton Woods system was the huge turning point.
Wait, remind me how Bretton Woods worked before it collapsed.
Well, after World War II, the global economy wanted stability above all else. So exchange rates were totally fixed. Governments pegged their currencies to the US dollar, and the dollar was pegged to gold.
Ah, okay, so it was this artificial architecture just to stop the crazy devaluations that made the Great Depression so bad.
Precisely. But that artificial architecture eventually buckled. By the early 70s, the system was just cracking under the weight of actual global capital.
Yeah, and the sources have this crazy anecdote from 1973 that really shows how impossible it was to control. The West German government was desperately trying to maintain their fixed rate against a US dollar that was weakening.
Which is a massive undertaking.
Huge. To defend that fixed peg, they actually had to intervene in the market. They bought nearly $3 billion US dollars just to try and prop up its value.
$3 billion in 1973 was just a staggering amount of money.
And it failed spectacularly.
Well, yeah, because think about the underlying mechanics. It is basically a central bank trying to fight the ocean with a bucket.
Right, because to buy those dollars, they had to print their own money.
Exactly. To buy $3 billion US dollars, the West German central bank had to flood their own market with Deutschmarks.
Oh, wow.
So that sudden influx of domestic currency creates this massive inflationary pressure at home. They were literally importing inflation just to keep a fake price stable.
It is like trying to catch a falling knife.
Mm.
And they got so badly cut that global FX markets were actually forced to close entirely for weeks.
Yeah, just to stop the bleeding.
So by March 1973, central banks universally threw their hands up. The fixed system was dead. Currencies were finally allowed to float freely, based purely on supply and demand.
Which is what gave birth to the constant, unpredictable price swings we see today. Price discovery is happening second by second now.
Okay, so if it is a freely floating market now, what is actually driving those prices up and down every single second?
Well, the OFX source breaks this down beautifully into 6 invisible hands, basically. 6 macroeconomic forces.
Right, I have the list here. It is economic indicators, monetary policy, trade balance, geopolitics, market sentiment, and interest rates.
Yeah, and to see how they work, let's start with trade balances. It is a very mechanical flow.
Like the ratio of a country's imports to its exports.
Exactly. Say Japan is an export powerhouse,
Yeah.
right? They are shipping massive quantities of heavy machinery to the United States.
Okay, makes sense.
Well, the American buyers can't pay the Japanese manufacturers in U.S. dollars. They have to actually convert those dollars into yen to settle the invoices.
Oh, I see. So that massive mechanical volume of buying yen drives the demand up.
Right, which appreciates the value of the yen relative to the dollar. It is just pure physical trade flow acting as a baseline.
But the waters get a lot murkier when you add in the other forces, right? Like economic indicators.
Yeah, inflation is a huge one. Inflation heavily degrades your purchasing power. If a government is printing money to pay off debt, the market prices that in instantly and the currency depreciates.
Okay, but wait. Let me push back on that sequence of events.
Sure, correct.
Because when we get to interest rates, the logic feels really paradoxical.
It does trip a lot of people up.
Right, because if a central bank raises interest rates, it usually means their economy is struggling with high inflation. They're trying to cool things down.
That is the standard textbook move, yes.
So why does the OFX source say that higher interest rates actually make a currency appreciate? If your economy is struggling so badly that you have to hike rates, shouldn't the market devalue your currency?
It completely sounds counterintuitive, but you have to remember that the primary driver of modern FX volume isn't physical trade anymore.
What is it then?
It is capital flow. Global investors, pension funds, huge asset managers, they are all in this perpetual hunt for yield.
Okay.
So when a central bank raises interest rates, the government bonds in that country suddenly offer a much higher percentage return.
Ah, so the currency itself is just like the entry ticket to get those high-yield bonds.
Exactly. If the U.S. Federal Reserve aggressively hikes rates, a European investor might decide U.S. Treasury bonds are way better than European bonds.
But to buy the U.S. bonds, they have to buy U.S. dollars first.
You got it. That massive influx of foreign capital rushing in creates an overwhelming demand for the dollar.
And that drives the price up,
Yeah.
completely overshadowing the actual inflation problem in the short term.
Right. The interest rate basically acts as a giant financial magnet.
That is fascinating. And the sources say we see a similar magnetic effect with geopolitics and market sentiment, right? With
Yeah.
these safe haven currencies.
Yes, the safe haven dynamic is wild. It is pure market psychology overriding regular economics.
Like the U.S. dollar or the Swiss franc. The OFX guide specifically calls those out.
Right. Imagine a major geopolitical crisis breaks out overnight, an armed conflict or a global banking panic.
Investors just panic and liquidate all their risky assets.
Exactly. They pull out of emerging markets and they want to park their wealth somewhere historically safe, somewhere impenetrable.
So a massive wave of capital just crashes into the Swiss franc.
And it causes it to appreciate violently, even if Switzerland's actual domestic economy didn't change at all that morning.
Wow. But okay, if you are a business doing international trade, that kind of violent volatility is a literal existential threat.
Oh, absolutely. It can wipe you out.
I mean, think about it. If you operate on a 5% profit margin and the currency of your main supplier suddenly swings 10% in a month because of some random geopolitical event.
Your entire year of profit is just vaporized instantly and has nothing to do with how well you run your business.
So how do participants even survive this? Because it is not just tourists exchanging cash at the airport.
No, retail tourists are a microscopic fraction of the market. The data shows 51% of all transactions are interbank,
Right, the massive players. JP Morgan, UBS, Deutsche Bank.
moving billions of dollars. And nearly 60% of those spot trades are happening on electronic platforms today.
Okay, so the PNC Banking Manual outlines the actual tools these institutions use to fight the volatility.
Let's walk through them because they are really clever.
The most basic one is just the spot transfer, right?
Yeah, spot is just immediate settlement. You execute the trade at whatever the price is right now, and the money changes hands in 2 business days.
But that offers zero protection against future swings.
Right. If you want predictability, you have to move to forward contracts.
I likes the analogy for this. It is kind of like pre-ordering a highly anticipated video game or locking in a mortgage rate.
That is a great way to think about it.
You agree to a price today to protect yourself against price hikes 12 months from now, even if you don't exchange the money until delivery.
To put it in a corporate context, imagine an American airline is buying a whole fleet of planes from a European manufacturer.
Hey.
The delivery and payment are scheduled 12 months out. The airline knows they are going to owe hundreds of millions of euros in a year.
And if the euro appreciates between now and then, those planes just became catastrophically more expensive in US dollars.
Exactly. So the airline and the bank execute a forward contract. They lock in the exchange rate today. No money changes hands right now, but the price is set in stone.
The exchange rate risk is totally eliminated.
Completely. And the PNC source also mentions window forwards, which are similar but give you a window of time to draw down the funds instead of one rigid date.
Which is nice for operational flexibility. But the tool that truly dwarfs everything else in daily volume is the swap.
Oh, swaps are massive.
The sources say swaps account for over $4 trillion of that daily 9.6 trillion figure. But honestly, the mechanics sound really dense.
They sound dense, but the underlying logic is actually very elegant. A swap is basically a spot trade and a forward contract jammed together simultaneously.
Okay, so an institution buys a currency for immediate delivery, and in the exact same agreement, commits to sell it back at a specific date in the future.
That is exactly it.
But why? Why buy money just to guarantee you sell it back?
It is all about liquidity management. Let's say a British bank has an excess of British pounds today, but they need US dollars to fund a short-term loan for a client.
Okay, they need dollars today.
Right, they could just sell their pounds for dollars on the spot market. But in 3 months, when the loan gets repaid, they have to buy those pounds back.
Exposing them to 3 months of totally unpredictable exchange rate risk.
Precisely. So instead, they enter an FX swap. They swap the pounds for dollars today and simultaneously lock in the rate to swap the dollars back to pounds in 3 months.
Oh, well. So they get the immediate cash they need for the loan, but they take on zero risk regarding the currency fluctuations.
It is the ultimate tool for moving massive amounts of capital across borders temporarily.
That makes so much sense. So that is hedging, mitigating risk. But the textbook also details the opposite of that, right?
Yeah, speculation, taking on risk for profit.
And the most extreme version of this is arbitrage. Honestly, reading this part felt like reading about someone finding a cheat code in a video game.
It really is a fascinating mechanical exploit.
Let's break down the textbook's example of triangular arbitrage because it is wild.
Okay, so triangular arbitrage relies on finding a fleeting moment where 3 different currency pairs fall out of mathematical alignment.
Right, so the textbook uses this hypothetical trader at a firm called Houseman Bank.
I remember that one.
This trader is just staring at the screens and spots this tiny anomaly. The Japanese yen is temporarily undervalued against the British pound, but it is priced correctly against the US dollar.
So the cross rates just don't match up.
Exactly. It is a tiny mathematical discrepancy.
Mm-hmm.
So the trader executes this rapid 4-step loop. First, they borrow 1 million US dollars.
Zip 1.
Step 2, they immediately sell those dollars to buy Japanese yen. Step 3, they sell the yen to buy British pounds.
Okay, routing it through the mispriced pair.
And step 4, they sell the British pounds to buy back the US dollars.
And because they routed the capital through that specific mispriced yen to pound cross rate,
When they convert back to US dollars at the end, they don't just have the 1 million they started with. The math shows they emerge with over $1,014,000.
wow!
They pay back the $1 million loan, and they just pocketed $14,000 in pure risk-free profit in seconds.
It is incredible. The textbook actually cites a historical study showing an interbank trader was pulling off a sequence like that every 67 seconds.
Wait, really?
Yeah.
Every 67 seconds?
Yeah. But in the modern market, human beings aren't doing this anymore.
Right. It is all algorithms now.
High-frequency automated algorithms scan for these mispricings 24/7. The moment a discrepancy appears, they execute the triangular sequence in milliseconds.
Which is crazy. And by aggressively exploiting that loop, the algorithms actually force the prices back into alignment almost instantly, right?
Exactly. They act as this brutal, high-speed corrective force.
But hearing the sheer scale of all this algorithms executing billions in arbitrage, $4 trillion a day in swaps, no central exchange, it makes me wonder about the rules.
The policing of it all.
Yeah, because this is an over-the-counter market, an OTC market. There is no central global regulator. It operates across dozens of countries at once. How is this not just the Wild West?
Well, the lack of a global sheriff is exactly why the industry realized they needed a framework.
So they wouldn't just consume each other.
Right. The fragmented regulations were leaving too many gray areas. So central banks and major market participants got together and drafted the FX Global Code.
Okay, so the code functions as the rule book. Right. It is not statutory law, but the big institutions publicly commit to its principles for ethics and governance.
Yes. And in an OTC market, you have to understand that the most valuable commodity isn't actually the currency.
It's information.
Exactly. Information asymmetry is incredibly dangerous. So the code places a huge emphasis on how confidential information is handled.
Specifically around this concept called market color, right?
Yeah, market color. It is basically the lifeblood of trading desks, the continuous flow of market gossip and sentiment.
But the code is remarkably strict about how that gossip is shared. It has to be heavily anonymized.
Very heavily. A market maker could tell a client, hey, we're seeing heavy corporate demand for the euro this morning, just to give them a sense of liquidity.
But they can't get specific.
No. The code explicitly prohibits sharing client names, exact rates, or the exact volumes of pending orders. They absolutely cannot say, a major German auto manufacturer is about to buy 500 million euros.
Because if a trader hears that massive order is coming, they know it will drive the price of the euro up,
Right, and they could just buy euros for their own book first.
pocketing the guaranteed profit while front-running the client. So the code tries to build a firewall against that.
Exactly.
But, as I was reading through the code's execution guidelines, I found a practice that genuinely made me mad.
Oh, which one?
It is an electronic trading mechanism called last look.
Yes. Last look. That is arguably one of the most debated mechanics in the entire modern market structure.
I mean, let me get this straight. A market maker offers a price. I hit accept to execute my trade.
Yeah.
And then, during this last look window, they get to review my acceptance and decide if they actually want to honor their own quote.
That is the basic sequence, yes.
If the market suddenly shifted against them during that fraction of a second, they could just reject my trade. How is that remotely fair? It sounds like a free option for them to back out of a losing bet.
I totally understand why it looks that way. And critics definitely argue it functions like a free option, but you have to look at the physics of electronic infrastructure.
The physics.
Yeah, latency. In a decentralized global market, a price broadcast from a server in London to a client in Singapore takes time to travel.
Okay, sure.
It might only be 20 milliseconds. But by the time the client's accept signal travels back to London, the broader market may have moved significantly.
Oh, I see. So the market maker is broadcasting a price that is technically stale by the time the acceptance actually arrives.
Precisely. Last look protects the market makers from being picked off by faster algorithms that are just exploiting that latency delay.
Okay, that does make sense structurally. But the obvious danger is what the market maker does with the information during that window.
Right, the information asymmetry again.
Yeah. If I hit accept on a massive order, the market maker now knows my trading intent. What stops them from rejecting my trade and then instantly using their high-speed algorithms to trade on that knowledge before I can find another seller?
That is the nightmare scenario, and it is exactly why the code permits last look, but heavily, heavily restricts it.
Okay, how?
It can only be used as a strict risk control mechanism. During that millisecond window, the market maker is allowed to do a validity check, like verifying the client actually has the credit to fund the trade.
Makes sense.
And they can do a price check, ensuring the market hasn't moved beyond a predefined tolerance. But they are absolutely forbidden from a practice known as pre-hedging during that window.
Pre-hedging. So they can't trade ahead of the client's order to move the market against them.
Strictly prohibited. They cannot use that split-second delay to gather information. And if a firm uses last look, the code mandates it must be transparently disclosed in their terms.
And they can't trade on the info from a rejected request. It is wild that the entire ecosystem operates on the assumption that the biggest players will just honor these frameworks.
But they generally do, because the alternative is basically catastrophic.
Right, because the trust and integrity of the FX market literally underpin international commerce. If participants lose faith that the electronic platforms are fair, liquidity just dries up.
And if liquidity dries up, a supermarket in London suddenly can't hedge the cost of importing produce from South America.
Or a tech firm in California can't reliably fund its engineering teams in India. The whole global supply chain relies on this invisible machine functioning smoothly.
It really is a remarkable balancing act. You have this market governed by centuries-old macroeconomic principles of supply and demand,
Executed by bleeding-edge technology.
and held together by a voluntary framework of trust.
It is incredible. So, just to bring this all together, we have traced this massive evolution from the Medici ledgers to a $9.6 trillion daily digital behemoth.
We covered a lot of ground.
We looked at how macro forces like trade flows, inflation, and the magnetic pull of interest rates drive the constant volatility of floating currencies.
And how the titans of finance use forward contracts and swaps to manage liquidity and lock in certainty.
While those high-speed algorithms hunt for arbitrage anomalies in the background. Plus, we saw how the FX Global Code attempts to police this whole decentralized landscape.
It really provides a comprehensive map of how capital actually moves in the modern world.
It does. So the next time you are booking a flight overseas, or you read a headline about the central bank adjusting interest rates, or you simply tap your card for an imported product, keep the mechanics of this deep dive in mind.
You are feeling the direct ripples of this vast ocean of global capital.
You are standing right on the shore of it. But, looking forward, the historical context leaves us with a pretty compelling question to mull over.
Yeah, because the FX market is always evolving. We went from physical gold standard pegs to floating paper fiat to high-frequency digital platforms relying on the traditional SWIFT banking network.
Right, so what happens to this entire ecosystem when blockchain technology and decentralized digital ledgers mature enough to bypass the traditional correspondent banking system entirely?
That is the billion or trillion dollar question. Will the $9.6 trillion FX market, as we've described it today, even exist in a few decades?
Or are we watching the final days of the current paradigm before it is replaced by a single automated global network?
It is going to be fascinating to watch.
The gears of the invisible machine are always turning. Thanks for joining us on this deep dive.